Hello and welcome back to the Property Frontline. My name's Debra. I am the founder of the Property Frontline Buyers Agency. Today we are here to do another episode of Market Watch with our very special guest, Scott Hoaxing. Hi, Scott.
Hello, everyone out there.
So Scott specialises in the new property space. So in this episode, we're going to do what we normally do, which is review the property market performance up until the end of the last month, which was the 30th of June, 2026. What an eventful 6 months. And then in every episode, we also go into a special spotlight on the market, and for this episode we are going to focus on the July to December market forecast plus a few other little things. So let's get into it. As normal, we'll go through the data from the main reliable data sources of Cotality, PropTrack and SQM Research. Scott, would you like to take us through the house price changes for Sydney, Melbourne, Brisbane and Adelaide?
Sure, Deborah. Thank you for that handover. We'll jump right into capital cities here. Sydney red across the board for the month of June. Cotality had that market down 1.5%. PropTrack down about half of that at 0.8%. And SQM's asking price data, quite a sizable drop, minus 2.7%. Down to Melbourne, the decline not quite as deep, so 1.3% down on the Cotality stats, 0.5% down with PropTrack. Then interestingly enough, the SQM number just a smidgen down at 0.2%. For those of you that have been watching our podcast over the months, last month we saw the exact same thing. Both Melbourne and Sydney were down for that month across all three data providers. Heading down to Brisbane, slight increase there with Cotality, up 0.2%, back 0.2% with PropTrack, so maybe call it flat. And SQM has asking prices down 0.6%. Down to Adelaide, flat market from Cotality, down just a little on PropTrack's numbers, 0.2%, and SQM up just a bit at 0.3%. I'm going to hand back over to Deborah, and she's going to take us through Perth and some of our smaller capitals there. Deborah?
Okay, so for Perth, Cotality has prices increasing by 0.7%, PropTrack down by 0.4%, SQM asking prices up by 1.2%. Go Perth! Hobart, Cotality has prices increasing by 0.6%, PropTrack down by 0.2%, and SQM down by 0.7%. Darwin, Cotality has Darwin increasing by 1.2%, PropTrack increasing by 0.2%, SQM down by 0.7%, and in Canberra down by 0.7% from Cotality, PropTrack minus 0.5%, and asking prices for some reason, SQM has the asking prices increasing in Canberra by 1.4%. It's almost like Brisbane doesn't know that it doesn't need to drop its prices. It's kind of like gone, oh, everybody else is decreasing. Like there's still so much more demand.
Yeah.
Anyway. All right, so let's have a look at the chart, because as everyone knows, I much prefer a graph than, a list of numbers. This chart tracks price changes over time. And as we can see here, now except for Hobart, every major city has started to contract in prices, which turns the properties down. So what are you seeing on the ground, Scott? Are you seeing a real change in the market?
From a price perspective, following land prices and new builds, really not a lot. I would call it sort of stable to flat. Seen some build price increases in some markets, but we really have just seen a large fall off in buyer interest and inquiries as everybody's sort of reacting a bit still to what we heard on May budget night. An occasional property does come up, and I do see people moving on it very quickly, but that's just always the case. They're very rare gems, especially in my part of the business, when you can see value and that, it's priced well beyond what you're seeing from other builders and developers. There's going to be some smart, savvy investor, or maybe someone's going to get a nudge from us to get onto that one quickly.
So interesting from my side of the fence, what I have found is the more experienced buyers are really, really active. Like, they know that this is a really great time to get some good bargains. And but we are seeing, I think, well, from my perspective, I'm seeing a little bit of a drop in supply, so lower listings, but we would normally see that in winter anyway. Is it a reaction to the budget? The agents will tell you that it is. And what the agents have said, for the last 4 weeks, they've been saying everyone's getting ready for spring. So those people who want to sell are preparing now. And from like buyer demand, I'm seeing it really, really split 50-50, still a lot of home buyers and a lot of property investors, or even people who are buying or who want to buy property for the future. So it might be their downsizer property. People are really starting to get active with that. And would I say that the budget has impacted decision making? There's certainly a lot of people who have taken the time to reassess. And so now that might be adjusting a little bit. And by that, I mean people who might have rent vested now have flipping back to go, oh, well, maybe I will see if I can buy in Sydney now because there's a little bit of relax in pricing.
Yeah, I actually have had a rent vester client or two, and in the past they would have been looking to buy that next investment property. And that's exactly what I've heard is they're going to take a very good look. Now they're in Sydney, so they're going to take kind of a very good look at what is available to them in this market over the next 6 months and see if they can stretch and reach to something that's a suitable home for their family, for the next 5 years, which is really the mentality you need to have.
Yeah, that's right. And so we'll see some of those people who did buy property a couple of years ago, the rent vestors, they'll put their properties on the market and see if they can flip into Sydney. So it's going to be a very interesting market, but let's get back to the data. So Scott, can you take us through the rental market overview?
Sure, Deborah. These are annual changes in rents for our capital cities. Just very strong growth continues in those small regional capitals. Darwin, rents growing at 10% up there for houses. Hobart, 9%. Then we move down to Perth and Brisbane. Now, they both have had a lot of growth in rents over the past 5 years. So this is really coming on top of a very high base. I don't think anyone would have predicted Perth rents would be growing at 8% at this point. Then down to Sydney, a strong 6.6%. I mean, inflation's about 4%. So that will give you some idea. Rents are outpacing inflation. Even in Melbourne, rents growing at 4.9% for the year. Adelaide as well. Canberra, they're growing at about inflation. Over on the right-hand side, we've got numbers for units. It's pretty similar lineup, I think. We've got Perth bumping up a bit, so Perth units are in high demand, good rental growth there. And Canberra probably stands out there as there being some additional supply of units there that's keeping the rental growth under control.
Okay. All right. What else have we got here? Would you like to take us through this one as well?
Yeah, we just pulled this out of a Cotality report. Just a nice snapshot of the entire country, focusing on vacancy rates for all of these capital cities. The general feeling is that 2% is a balanced market. I've even heard people say 3%, but I really think 2% is kind of the number we're looking at these days. Every capital city is in the ones. Some of them are low ones, like Adelaide, 1.0% vacancy rate there. Melbourne's is even 1.3, which is very tight for a rental market. And on the right, they're showing the median rent for a dwelling in each of those markets. So most expensive markets to rent in are, of course, Sydney, Perth now, second highest in terms of being able to rent a property. And cheapest on that list, look at that. You go all the way down to Melbourne, $641. So I would call it a rental powder keg is sort of the term I would use. It's a very, very tight market, and it will not take a lot for something to really set this off further.
Yes. Something like a decrease in supply.
Yeah, exactly. Yeah, so Deborah, maybe you want to run us through this one. These are hot off the presses, some stats we just got today from Cotality, right?
Yep. That's right. So once again from Cotality, showing the change in rents over the last 3 months. So we can see there Darwin has the biggest jump, admittedly off a low base, and then Hobart second biggest, Canberra the smallest. This is for houses, but overall everybody increase in rent. And of course, everyone is watching rents now, because if rents really jump up, then Labor will be in all kinds of pain. But anyway, we told them.
Obviously, just the trick is take it times 4 to annualize the number. Doesn't mean it's going to grow that fast over the next 12 months, but 4% growth for the quarter times 4 is over 15% rental hikes for the year. So if that continues, I think we all agree we were going to hear a lot of screaming out there from tenants.
Yeah. And that's the other point to make as well. We won't always see an immediate change in rents, although we can see the pressure is really building. But remember, most parts of the country, you cannot change the rents until the annual anniversary comes up. So, it will take 12 months for this to really wash through.
Yeah.
All right. So let's take a look at market factors. So what happened over the last 4 to 5 weeks that's going to impact the property market in the next 2 to 3 months or beyond. So number one, the RBA held their June meeting, no change to interest rates. The next one is scheduled for the 11th of August, so next month. I have my opinions on what should happen, but I'm sure you have yours. Then the biggest piece of news, obviously, was on the 25th of June. The budget tax changes were approved, and to get that through, the government added just one extra layer of change that hit the SMSF market, where they stopped the ability for people to use lending to purchase residential property in their SMSFs. And you know what? They were targeting the property hypers, like the, spruikers, but there's better ways to, control spruikers than to do what they've done. But
it's also causing just a burst of buyer activity in that segment now too. And I think we would just highlight the risks for anybody that are out trying to chase that closing window, trying to set up self-managed super funds in a short period of time, find a property, get the loan in place. Just be very, very cautious. Be acting with very good advice for anyone who is trying to get in under that window.
Yeah, I think the window closes on the 10th of August. So they were given 40 to 45 days from the original announcement. And but anyway, so there is a lot of media news about the market softening at headline level, which is really quite interesting when you read into it, because some of the things they're saying is quite, outrageous, but whatever. Other news, the National Rental Affordability Scheme, which was like a really bad thought bubble from the government, that has now ended, which was where they incentivized buyers and covered rent to a very high level. And yeah, that was a very bad scheme that meant that there was a lot of properties that were built in the wrong areas. But anyway, that's all ended now. Anti-money laundering has now come in from the 1st of July into the property market. So that means that there will be a higher level of scrutiny about sellers and buyers. But from our perspective, that means that poor buyers might be checked, like they'll have to prove their ID and where they're getting their money from. They'll have to prove that with their broker, their solicitor, their buyer's agent, and also to the real estate agent. So that is just control gone wild. But once again, we'll wait and see what happens with that. Do you have any comments on that, Scott?
Just don't get upset with your advisors in that space, because we're only doing what the government's making us do. And it's frustrating being in the business and having all this additional regulation and paperwork put on us as well. And costly, by the way.
That's right. That's what I was going to say. We have to pay for it.
We have to pay for the costs for all of this checking, yes.
And what would you like to say about the Middle East conflict?
Oh boy. Well, changes on a weekly basis. We certainly thought it was done and dusted, and there was that big agreement coming, but seems to be maybe falling apart. Bombs dropping again. I would just not assume that is going to end quickly or gracefully. There's no, I think, panic there yet, but the markets are reacting in interesting ways. Oil prices are starting to go back up again, which means that great deal we've had at the pumps on our petrol may start inching away. Yeah, so just like I said, stay on top of that. We've got a very uncertain situation there, and let's be hopeful.
But it is interesting. Now it's kind of like buried in the headline. Like it's not even making like front page news.
You could probably get to a whole newspaper and not see a Middle Eastern story, honestly. Yeah, exactly. So, and the markets are quite resilient. We're talking stock markets here. There hasn't been any major plunge in stock markets, and they're only a couple of percent off their all-time highs. So at least that's what that part of the market is. They're evaluating constantly what's happening in the Middle East and trying to figure out, is it going to have a big effect on the economy or not?
Yeah. I think it's already had its effect, but whatever. Okay. So on to our In Focus forecasts for not only the next 6 months, but the next 6 to 12 months. Right. So before we get into the forecast, let's have a look at where we actually are. Scott, can you cover off Sydney, Melbourne, Brisbane, and Adelaide for this chart?
Sure, Debra. We like this Cotality information because it shows us the last 5 and 10 years, along with kind of what's been happening. So Sydney, is off 3.7% from its peak. So, I know you're going to hear different stories from the media there that it's off a lot more, but that's really the average or median number that we've come back from. And growth in the past 5 years, not a lot of growth in Sydney, 12 point. I'm sure, Debra, you would pick some markets that maybe add a zero on that, right? So we're talking a market-wide number there.
And markets that have absolutely smashed it.
Done that in the last year. Yeah. So, but these are very broad numbers. It's up 54% in the last 10 years. We'll go through these sort of relatively quickly. Melbourne is off 4% from its peak. Now, that peak was not a couple of months ago, actually. That was back in 2022. So it's had that rough patch over the past 5 years. Have a look at that number. We were talking about that before the podcast. Only up 1 point over the past 5 years in Melbourne. And with 3% inflation a year, that's sort of like going backwards 15.
Yeah.
One way to think about that, and just 30 growth over the last 10. Brisbane and Adelaide, they're both at their peaks. Good price run-ups in the last 5 years, 70% up, well more than doubling in the past 10. We just don't have too many time frames where markets do have that sort of surge in a 5-year period, where there's almost not an expected, I don't want to call it, plunge, but backtrack. The market kind of regroups, it digests that gain, and then everyone sort of decides we're ready for another run. Debra, you want to take Perth and the other ones there?
Okie dokie. So Perth is still marked at the peak. Over the last 5 years, has increased by nearly 90%. Past 10 years, just over 100. Hobart is starting to dip from its peak, which the last peak was March 2022. Over the last 5 years, increased by 17, and last 10 years by 95%. So it is really starting a bit of a run, but yeah, it's too small a market. It won't be sustained. Darwin still at peak, past 5 years, up by 33%. And that has all happened in the last 5 years. Because, so no growth for the 5 years prior to that, because over the past 10 years, it's grown by 33%. Canberra, down a little bit from the peak, so nearly 3% down. The last peak date was May 2022, increased slightly over the last 5 years by 12, nearly 13%, and over the last 10 years has been up by just 62%. And I'll just quickly cover off the regions, because this is where we're going to see a lot of the change in the next couple of years. So regional New South Wales and Victoria have contracted just very slightly by 0.1 and 0.2%. Their peaks, they're saying in this report, were April 26 and May 26, and have increased in the past 5 years. New South Wales by 31%, Victoria by 18%. But in the past 10 years, regional New South Wales went up by 97%, whereas regional Victoria up by 81%. Now, regional Queensland, South Australia, WA and Tassie are considered to still be at their peaks. In the past 5 years, all four have increased from nearly 36% up to about 90%, between them. And then on the past 10 years, all of them have, doubled or done better. So that's, where we're at the moment. Scott, do you want to have a quick chat about this one?
Sure. Behind every single point of data on a market, there are market segments. And this really shows you how the growth breaks out in these capital cities. So we've got the cheapest 25% of dwellings, the middle 50%, and then that 75% is the top 25%. And what this really shows is the declines are the largest in Sydney and Melbourne on the expensive end of town, which is kind of what would be expected. They've got the largest mortgages. They're the mostly geared up. But look at Sydney, this is 3 months through May. Actually, that cheaper end of the market is actually positive. So all the stats are negative citywide, but there still are going to be those parts of the market that may be growing. You go to some of the other ones like, Brisbane, Adelaide, and Perth. There, of course, we're still all growing during that time frame, but it's the lower price properties in each of those markets that had the highest growth.
Yeah.
I think, Debra, that probably overlaps a lot with your buying strategy in some of those markets as well.
Yeah.
So anyway, the kind of big picture, I think, is don't just take a single point of data and walk away thinking you know the market and be thinking about the different segments. This is just a very simplistic way of thinking about cheaper and more expensive properties and where that growth is actually occurring.
Yeah, good point. All right. So, what's really happening now and what are we expecting to happen in the market? So, currently, the media is saying, oh my goodness, auction clearance rates are tanking. Well, this chart, which is from SQM, tracks clearance rates, auction clearance rates, weekly for the past 3 months. And I cannot see a trend line going down. Sure, the clearance rate is low, so it's definitely indicating a buyer's market. Anything under 50 for me is a buyer's market. Yeah, so auction clearance rates are, closer to the 30%, but they're not continuing to go down. Anyway, and that's the same in Melbourne. So it's kind of flatlining, but that's, so you have to be careful about what you're reading. So another perspective of the auction clearance rates from a longer timeline, and this is from Westpac, and we can see here they've got Sydney and Melbourne, and Sydney clearance rates really started to track below, well, they're saying below the 60% clearance rate line. That really started to happen in the second half of 2025. And yeah, while this one isn't actually showing that it's flatlining, I think over time we will, once the data, comes through, you'll be able to see it is tracking just a little bit sideways. And then Melbourne, the same, but it started to drop in probably the first half of 2025. Anyway, so that's a longer term view. But when we talk about prices, so we'll hear the market say, oh, prices are going down. We all know, because if you've been listening to Market Watch for a long time, we say it nearly every time, that price data is what's happened in the past. It's not going to tell you what's coming in the future. The indicator that we need to really look at more closely to tell us what's really happening and going to happen in the market is supply. So let's take a closer look at that. This Cotality chart, you can see 2026, which is this purple line. So the flow of new listings, there hasn't been a big uptick in supply, and it's actually still trending lower than the 5-year average. So we would like to see a little bit more supply there. And then the number of total listings, we can see that line starting to increase because it's showing cumulative properties where the property is taking a little bit longer to sell. So this would indicate that generally we might start to see a little bit of softening in the future. And then, Scott, would you like to take us through this next slide?
Sure. The other piece of the equation with demand is supply, and in particular new supply. And we're always kind of curious to see how those numbers are tracking versus the government targets. So we've got growth in commencements. So commencements would be builders going to site to build a block of units or a house or a townhouse. We've got growth in total commencements in the past, looks like about 2 years there, but we're up to 48,000. But the target to hit the government's 1.2 million homes is 60,000. So we're well short of what we need to be running at. And if you look at this gray box, that's over the 5 years the target runs. We actually would need to jump up to 66,000 commencements a quarter and run that through 2029 to hit the target. We're at 48,000 now. So this has been out in the media everywhere. We're going to come in way short of what the government would like to build, what would like industry to build. Slightly increasing, it appears, but there is that small backtrack, which may be due to kind of the war and diesel prices and kind of that affecting some of the builds in that quarter.
Well, and the fact that we've got not enough brickies and all the other people that we need to actually build the homes with.
And they're also all getting hired up to build the Olympic infrastructure up your way. So
sorry.
I suspect that some of those government contracts are looking a bit more compelling to those brickies as well. Yeah.
Okay. So, Scott, would you like to cover off this slide?
Sure. A lot of panic in the media, market declines, Chicken Little, whatever you kind of want to call it. I like this chart because it shows we've had a lot of market declines in this country over the past 40 years. We've actually had 10. So we've had 10 declines in the past 40 years. This is a nationwide number, but just to kind of give some perspective here, because we all know what happened in the US during the GFC, where they had market declines of 20, 30% or more in their property prices. We haven't had any nationwide falls that have hit 10%. Looks like close to 9. That 2017 to 2019 drop was sort of one of the largest ones. Now, Sydney itself did drop almost 15% during that time frame, for those of us that remember that. So we may have some cities that have got sharp drops here. But then the markets have turned around. So the longest decline here has gone on for 21 months. Then that decline ended and that market started improving. Will this one mirror any of those? I don't think any of us know, because we've got some changing factors this time around, but it is good to kind of look at history and take all of this with some perspective. That we've had these declines before, and at least in this country, there have eventually been bounce backs. It hasn't taken that long.
So let's take a look at the forecasts. So we've got one bank that has been brave enough to forecast over the next 12 months, and also one data center. So I'll just take you quickly through this one from Westpac. So Westpac is forecasting that to the end of 2026, we will see a contraction in Sydney, down by around about 3%, but by 2027, bouncing back up by 2%. Melbourne, they're forecasting another drop of about 4%, but increasing to 5% in 2027. Brisbane, Westpac is forecasting the next 6 months for further price increases by 9%, and by 2027 they're expecting that to settle down to an increase of 3%. Perth, they're saying we'll see the year out with a 13% increase, but then that one's starting to cool off a little bit with only 5% increases in 2027. Adelaide, they're still seeing Adelaide up by 7, but settling to 4 in 2027. And then Hobart, slight bump in Hobart towards the end of the year, and then a little more of a bump in 2027. All right. And Scott, can you take us out with Domain?
Sure. On the second set of forecasts we've gotten that we had some amount of confidence in part because they've actually broken out forecasts for all the capital cities. Many of the other forecasters seem to only want to put a nationwide number out there, which, is pretty useless for any of us to kind of operate on.
Yeah.
But Domain, we're going to look at the fiscal year forecasts there. So that's 26, 27. So that's their guesstimate for basically now through next June, what's going to happen here in Sydney. So Sydney -3 to -7%, so averaging a 5% drop coming in the next 12 months. Melbourne's -4 to -8, that's a 6% drop. The Brisbane numbers look closer to Westpac there, so up 3 to 7, which would be an average of 5. Adelaide, pretty decent there, 4 to 8%, so that would be 6% growth, and Perth 5 to 9, which would be a 7% average. Canberra, they're a bit more negative on Canberra, treating it a bit more like Sydney and Melbourne. So that's an average of -2%. So there's maybe a little bit more spikiness, I would say, in their numbers. It's not an exact overlap with the Westpac timeframe.
benefit of this one is they have split out houses and units, and yeah, you can see there is a little bit more positivity on the unit side generally, which makes sense to me as well, because we might see people who are chasing yield to now start to switch more to the unit side of things,
Yeah,
as long as the
you know,
property
and
stands
and
up.
for Sydney units, I can think of two types of buyers there. Home buyers that now have got a chance to buy a nice 2-bedroom unit or a 3-bedroom townhouse near the city, and they're all kind of jumping in and hungry.
Mm.
But there may be a class of investors who's been sitting on units for quite a long period of time, and with the government's announcements and so forth, they may be throwing in the towel and saying, "I'm
Yeah,
take my gain now and move it into some other type of investment." So
yeah, yeah. So that is it for the forecast. So if you're working on your strategy and trying to figure out what to do now, remember the tips that we always talk about. Watch out for misleading data. Use only trusted sources, independent sources. Always conduct the financial pros and cons, because the market has never been more nuanced since the budget changes came in. Use criteria that's tailored to your requirements. So what's right for someone else might not be right for you. And if you would like some help, you can reach out to Scott. His contact details will be in the description box below the podcast. And you can find him on his Facebook page, Scott the Property Coach. If you would like to really work on your strategy, mapping what's actually happening in the market, and can you buy something better than you thought you could before the budget, that's what we'll be covering off in our next Property Smart Start workshop, where we will show you how to choose the best strategy for you and your circumstances. Avoid getting stuck with a bad property. We'll help you filter noise and avoid false certainty, and use decision rules that work in today's market. So details for that will be in the description box below. And so thank you very much for watching. Next time on Market Watch, we'll be covering one of our favourite topics. We'll be doing a revisit of our regional location watch, plus lots more. Thanks again for watching. If you would like to subscribe, make sure you click the box. And once again, remember to reach out for us if you've got questions or would like some help. So thanks for that, Scott. See you later.
all those Maroons fans out there, better luck next year. There'll always be another year.
That's right, there will. Okay.